So California Resources Corporation, ticker CRC, they just pulled off one of the strangest financial magic tricks of the quarter.
Yeah, that's definitely one way to put it.
I mean, they delivered a mixed Q2 2026 earnings report that just completely bifurcated on the top and bottom lines. Adjusted earnings per share came in at 99 cents, which severely missed the consensus estimate of $1.36 by a full 37 cents.
Right, a huge miss there.
But then on the top line, revenue surged to an unexpected $1.3 billion, absolutely crushing Wall Street expectations of roughly $960 million. That is a massive 33% year-over-year increase.
That's wild to see that kind of split.
Totally. And management held firm on their forward outlook, too. They maintained their full-year capital guidance of $520 to $560 million, held net production guidance steady at 150 to 155,000 barrels of oil equivalent per day, and they noted expectations for Q3 oil realizations to hover around 93% of Brent crude.
Which brings us to how the market reacted,
Yeah.
right?
Exactly. Despite the significant earnings per share miss, the market heavily rewarded the top-line revenue beat and the underlying cash generation. Shares jumped over 5% in pre-market trading and closed up around 3.2% on the day of the release, settling at $53.75.
Deciphering that market reaction is the exact mission for this deep dive. I mean, getting the headline numbers out of the way is the easy part, but our goal today is to help you understand the actual mechanical reality beneath this incredibly complex earnings report.
Because there is a lot going on under the hood here.
There really is. We're going to break down CRC's segment performance to show you where the cash is actually flowing versus where the accounting noise is happening. We'll unpack management's structural solutions to their current bottlenecks, specifically a major new pipeline acquisition, and evaluate their underlying efficiency metrics.
Right.
And most importantly, we're going to map out the substantial risks facing this company as they attempt a massive corporate pivot. CRC is trying to transition from a legacy California oil and gas producer into an integrated energy and tech infrastructure platform.
Which is no small feat.
Not at all. And as these Q2 numbers vividly illustrate, that kind of transition involves severe operational friction.
Yeah, let's unpack that immediate contradiction right now. Because a $300 million revenue beat paired with a near 30% EPS miss requires some structural explanation. It honestly reminds me of a restaurant on a Friday night where, the kitchen is pumping out 500 meals an hour, operating at peak capacity.
Okay, I like this analogy.
Right. But the doors to the dining room are jammed. The food is just piling up on the counters. It's getting cold. You can't sell it to the waiting customers, and you're running out of physical space to even store it. The production is there, obviously, but the logistics completely ruin the margins.
That jam door analogy perfectly isolates the mechanism at play here. Because to find the missing profits, we really have to track the physical barrels.
The actual oil.
Exactly.
Right.
CRC averaged 149,000 barrels of oil equivalent per day this quarter. And crucially, that production mix is heavily weighted toward liquids. Like 81% of that output is crude oil.
Which, pulling that volume of oil during a relatively stable pricing environment should mathematically just drop straight to the bottom line, right?
It absolutely should. However, the primary culprit for the earnings per share miss was severe, albeit temporary, takeaway constraints in the California market.
Okay, takeaway constraints, meaning like localized pipeline maintenance or downstream refinery bottlenecks, essentially left CRC's crude stranded.
Yes.
So they had the product out of the ground, but literally no physical route to move it to the end buyer.
The infrastructure simply choked. Because of these localized logistical bottlenecks, CRC was forced to route their production into physical storage. They built up an excess inventory of approximately 137,000 barrels of oil.
Wow.
Yeah, to put the scale of that into perspective, they are sitting on roughly 1.5 million barrels of oil equivalent per day of trapped capital.
That's brutal. Because when hydrocarbons just sit in a storage tank, they generate zero return while you're taking on active holding costs.
No.
And beyond the physical storage fees, you're taking on massive localized price risk, right? If you can't move the oil to premium coastal markets, you're forced to sell it at steep regional discounts whenever the bottleneck finally clears.
You nailed it. That combination of factors, the inventory holding costs, the widening of those regional oil differentials, and the elevated secondary transportation expenses required to find alternative routes. All of that resulted in a direct $25 million hit to their adjusted EBITDAX.
Ouch. And just as a reminder, that metric bypasses all the accounting noise like depreciation and taxes,
Right.
and it just measures the raw cash-generating power of their operations.
Right. Taking a $25 million haircut right at the operational level is exactly what drove the earnings miss.
Which makes the net income figure in their press release even more baffling for retail investors who are just trying to parse the headline data. I mean, the reported net income was a whopping $514 million.
Yeah, that number jumps right off the page.
It does. If you only look at that gap figure, it looks like the most profitable quarter in company history. But digging into the SEC filings reveals that number is fundamentally an accounting illusion.
It is. The GAAP net income figure is heavily distorted by mark-to-market derivative accounting. That $514 million was artificially inflated by a $370 million non-cash gain on their commodity derivatives.
Interesting. So, as a traditional producer, CRC actively hedges their future oil production to protect against price crashes. They buy derivative contracts that lock in a specific selling price for future quarters.
Correct. So when the forward curve of global oil prices drops during the quarter, the value of those protective derivative contracts mechanically spikes on paper because their locked-in price is now higher than the current market rate.
I see. And accounting rules dictate that you must record that spike in the derivatives value as net income today.
Exactly, even though those contracts haven't settled and no actual cash has entered the corporate bank account.
It's pure paper profit.
100%. When you strip out that $370 million paper gain and isolate the actual cash-generating power of the physical oil business during Q2, the adjusted net income was a much more modest $88 million.
Got it.
That $88 million reflects the operational reality of the takeaway constraints, and that is the figure that missed Wall Street's consensus models.
Okay, that makes perfect sense. So that $25 million hit from trapped oil clearly forced management's hand on capital allocation. They just announced a definitive agreement to acquire Crimson Midstream Holdings for $63 million in cash.
They did.
But looking at the balance sheet, spending $63 million on legacy pipe is a heavy capital layout. Is this a structural fix to the California takeaway constraints, or are they just deploying a Band-Aid to appease institutional investors frustrated by the Q2 bottlenecks?
Evaluating the geography of the California crude market shows this is actually a highly strategic structural fix. Moving oil out of the San Joaquin Basin to the coastal refining complexes is notoriously constrained.
It's a bottleneck nightmare.
Exactly. So for $63 million, CRC is acquiring roughly 2,000 miles of active California crude oil pipelines and the associated storage terminals. By bringing that infrastructure in-house, they're executing a classic vertical integration play.
Oh, they are essentially buying the toll road.
That's exactly what they're doing.
By owning the Crimson network, they completely insulate themselves from the third-party transit bottlenecks that stranded their barrels this quarter. It gives them unhindered access to the higher-margin coastal refineries.
Furthermore, it fundamentally flips their relationship to the midstream market. The Crimson network doesn't just service CRC, it moves crude for multiple operators in the state.
Right.
So by acquiring the asset, CRC transitions from being a toll payer to a toll collector. They add stable, predictable third-party midstream fee revenue to their balance sheet. It transforms a logistical vulnerability that just cost them $25 million into a recurring cash-flowing asset.
Okay. Shifting capital into midstream logistics makes strategic sense, but it begs a serious question regarding their upstream operations. Regulators in California operate one of the most stringent permitting environments globally.
Yes, they do.
Because of the current regulatory backlog, CRC is essentially handcuffed, operating only a single rig for new drilling. I mean, how do you maintain a 150,000 barrel a day production profile when your drilling program is effectively capped by the state?
The regulatory friction is absolutely the most prominent bear thesis surrounding the stock right now. Operating a single rig severely limits organic volume growth.
Yeah, I'd imagine.
And compounding that pressure is a bearish projection regarding their secondary power operations.
Oh, right, the power stuff.
Yeah, CRC historically generates significant revenue, providing resource adequacy, essentially backup baseload power to the California grid.
Right.
But projections indicate those specific revenues could compress from $150 million down to around $100 million by 2026.
Wow.
Mostly because more competing power capacity is coming online statewide.
So management is navigating a capped drilling program and a projected $50 million headwind to their utility revenue. That places immense pressure on their ability to execute operational efficiencies. They can't drill their way to higher revenues, so they have to ruthlessly cut costs.
The data suggests they're doing exactly that. Following their merger with the Berry Corporation, management established specific synergy targets to eliminate redundant costs.
Okay.
In this Q2 report, they confirmed they have implemented 100% of those 2026 synergy targets a full 6 months ahead of schedule.
Oh, wow.
Yeah, that rapid integration secured $103 million in permanent annualized savings. And because they identified those efficiencies so quickly, they actually raised their long-term cost reduction target to $470 million by 2028.
That's huge. Squeezing $103 million out of the corporate structure is significant, but it still doesn't explain the wellhead physics. You still have to extract the oil to generate the cash. Are they just running the legacy wells harder?
No, the engineering metrics from that single rig are really where the underlying value is being created. CRC reported a 25% improvement in their California drilling efficiency.
25%.
Yeah, they have significantly reduced the cycle times required to drill and complete a new well. More importantly, the wells they are bringing online are drastically outperforming their type curves.
Now, for those tracking the industry metrics, a type curve is the engineered depletion model of a well, right? It predicts exactly how much oil will flow on day one and how quickly that flow will decline over time.
Precisely. CRC's filings show that nearly 80% of the wells drilled this year produced over 10% more oil than those initial engineering models predicted.
That's a great beat.
It is. Because they are drilling 25% faster and getting higher initial production rates, they require less total capital to maintain their baseload volume. Management subsequently lowered their long-term maintenance capital estimate by 5%, bringing it down to between $450 and $475 million.
Producing more oil with less capital immediately liquefies the balance sheet. I see here they generated $114 million in free cash flow this quarter and are sitting on $1.32 billion in total liquidity.
Huge buffer.
They are also maintaining a 3.1% dividend yield. But the most critical financial maneuver this quarter was the debt restructuring, wasn't it? They successfully refinanced their 2029 senior notes, extending that debt maturity all the way out to 2035.
Clearing that near-term maturity wall is the linchpin of their entire corporate strategy. By pushing the principal repayment out by 6 years, while simultaneously reducing their annual interest burden by $5.5 million, they have manufactured an 8-year financial runway.
Right.
They no longer have to stockpile cash to pay down imminent debt.
Which allows them to utilize that free cash flow to fund a massive identity shift. We discussed the regulatory cap on traditional drilling in California. CRC seems to recognize that expanding legacy oil production in the state is a losing battle.
Oh, completely.
Consequently, they are aggressively pivoting toward alternative energy and tech infrastructure. It's a radical transition. It's essentially an exploration and production company attempting to market itself as a carbon management and AI infrastructure play. It's like an old-school gold prospector suddenly pivoting to mining Bitcoin.
That's the way to put it.
How viable is it for an E&T company to suddenly become a tech and carbon management play for retail investors?
Well, the pivot sounds disjointed until you evaluate the physical infrastructure they already control. Let's examine the carbon capture subsidiary, Carbon TerraVault I. This quarter, they achieved a major operational milestone by officially commencing physical CO2 injection.
Okay.
They are currently capturing and injecting roughly 270 metric tons of CO2 per day, with the infrastructure scaling toward an annualized target of 100,000 tons.
What is fascinating here is the subsurface geology. The exact rock formations at Elk Hills that successfully trapped high-pressure hydrocarbons for millions of years are geologically perfect for permanently sequestering compressed CO2. They are extracting the oil, leaving a geological void, and then monetizing the process of filling that void with industrial carbon.
It completely flips the traditional energy model. Historically, carbon emissions were an inescapable regulatory liability for an oil producer.
Right, a cost of doing business.
Yep. By leveraging their proprietary understanding of the Elk Hills geology, CRC is transforming a historical liability into a standalone, fee-generating business unit. But the carbon sequestration is only half of the transition strategy.
Right. The other half is the data center proposal, which is arguably the most ambitious aspect of their pivot. CRC is partnering with Beacon Data Centers to develop a 275-megawatt campus at the Elk Hills field, designated as the Golden Valley Technology Hub.
The logic here connects directly to the broader macro constraints of the artificial intelligence boom. The primary bottleneck for hyperscale AI development is no longer the procurement of microchips, It is securing uninterrupted baseload electricity.
Power is everything right now.
Exactly. Traditional data center developers are facing years-long queues to connect to public utility grids. CRC bypasses that entire process because they physically own the Elk Hills power plant.
Right. They possess the raw land, the established cooling infrastructure from their legacy operations, and the on-site natural gas power generation.
It's all right there.
By building the data center directly next to the power plant, they're establishing a behind-the-meter integration.
And bypassing the public transmission grid and the associated California Independent System Operator queues provides massive value to hyperscale tech clients. This dual strategy, commercializing the carbon storage and providing closed-loop power for AI data centers, is the foundation of their goal to become an integrated energy platform.
It's brilliant, honestly.
It is. It fundamentally decouples their future revenue growth from the severe boom and bust volatility of global crude prices.
Okay, the theoretical integration of legacy cash flows funding tech infrastructure is compelling. However, that brings us to a stark contradiction in the market data. If this hybrid E&P and tech model is so robust, why are major institutional insiders heavily liquidating their positions?
Ah, the insider selling.
Yeah. Looking at the filings over the last 6 months, there have been 0 open market insider purchases. 0. Conversely, there have been 7 major insider sales. Most notably, the Canada Pension Plan Investment Board unloaded 3.5 million shares, cashing out over $213 million in a single quarter.
Yeah, a $213 million liquidation naturally creates downward pricing pressure and, it warrants severe scrutiny. However, evaluating institutional capital flows requires understanding the specific mandates governing those funds.
What do you mean?
The Canada Pension Plan's exit is less likely a referendum on the viability of the Golden Valley Tech Hub and more likely a reflection of rigid ESG environmental, social, and governance mandates.
Oh, I see. Many sovereign wealth and public pension funds are operating under strict directives to structurally divest from all fossil fuel producers by specific dates, regardless of how aggressively those companies are pivoting into carbon capture or tech infrastructure.
Exactly. Their mandate forces the sale, which is why isolating the broader hedge fund and institutional activity provides a more accurate reflection of market sentiment.
Gotcha.
Funds operating without those strict ESG limitations are heavily engaged. In the most recent quarter, 184 institutional investors added CRC to their portfolios, compared to 165 that decreased their positions.
So they are buying.
Yep. Despite the pension fund exit, institutional ownership of the outstanding float remains incredibly tight at nearly 98%.
So the underlying smart money is essentially holding the line, prioritizing the data center upside over the near-term takeaway constraints. And that sentiment is mirrored in the analyst coverage too, right?
It is.
Despite several research funds lowering their price targets immediately following the Q2 earnings miss, the broader Wall Street consensus remains a moderate buy.
The median price target among covering analysts sits firmly in the $72 to $74 range. With the stock currently trading near $53, those models suggest a potential upside of approximately 36%.
That's significant.
Very. That discrepancy indicates that the broader market is currently valuing the stock based entirely on the localized logistical friction of Q2, while the analysts are modeling the long-term cash flows derived from the Crimson pipeline integration, the Berry synergies, and the impending tech infrastructure buildup.
So synthesizing this complex quarter for the retail investor, CRC is actively navigating a highly volatile transition. In the immediate term, physical takeaway constraints and pipeline bottlenecks forced an inventory build that directly suppressed their operational margins.
However, management is actively deploying capital to eliminate those bottlenecks through the $63 million Crimson midstream vertical integration. Simultaneously, their ability to drastically accelerate $103 million in corporate synergies while beating drilling efficiency metrics provides a stable financial floor. And by refinancing their debt out to 2035, they've secured the capital runway necessary to execute their broader transition.
They are utilizing the cash generated from their legacy, highly efficient oil extraction to incubate next-generation infrastructure. The operational carbon TerraVault and the proposed 275-megawatt Elk Hills data center represent a radical evolution of the corporate identity.
It is the definition of a hybrid investment. You are acquiring a structurally sound, cash-flowing traditional energy asset that is leveraging its existing geographical advantages to capture high-margin tech and utility revenues.
Which leaves us with a critical concept to consider regarding the broader energy landscape. If California Resources Corporation successfully builds and integrates a 275-megawatt AI data center using behind-the-meter baseload power at a legacy oil field, could the exploration and production sector of the future look fundamentally different?
It's a huge question.
Could the traditional oil companies of tomorrow evolve away from being pure play extraction businesses at the mercy of global crude markets and transform into critical, stabilized nodes of global tech infrastructure? And if the sector successfully executes that pivot, how will the market fundamentally rewrite the valuation multiples assigned to these traditional energy stocks? It's definitely something to think about.
Absolutely.
Well, to stay ahead of the curve on these structural market shifts and to ensure you understand the mechanics behind the headlines, make sure you follow the show for daily earnings coverage.